Something is hiding inside NIO's next earnings report, and it is not the delivery number everyone keeps repeating. The market already knows NIO delivered 107,658 vehicles in second quarter. It already knows growth was almost 50% year over year. It already knows the company missed its own guidance by a small amount. But the real shock is not the number of cars NIO sold. The real shock could be what those cars reveal about margins, costs, cash burn, and whether this turnaround is actually real. That is why September 1st could be the biggest NIO stock catalyst of the year. NIO will report second quarter earnings before the US market opens, with a conference call at 8 a.m. Eastern Time. And this time, the market is not looking for another nice headline. It wants proof. Proof that first quarter was not a one-time margin surprise. Proof that the new product cycle is not just creating volume, but better economics. Proof that NIO can grow without burning through the progress investors have waited years to see. Subscribe with one quick tap because this earnings report may expose the truth behind the comeback story. The setup is dangerous because both bulls and bears already have ammunition. Bulls can point to second quarter deliveries of 107,658 vehicles, up 49.4% year over year. That is serious growth, especially in a brutally competitive Chinese EV market. But bears can point to the guidance miss, because NIO had expected 110,000 to 115,000 deliveries. So the headline looks strong, but not clean. And when a stock is still trading under $5, that difference matters. Investors are not giving NIO the benefit of the doubt anymore. They want the numbers to prove it. That is why the most important figure in the earnings report will probably be vehicle margin. In first quarter, NIO's vehicle margin surged to 18.8% compared with 10.2% 1 year earlier. That was the number that made investors think the business might finally be changing underneath the surface. It suggested NIO was not just delivering more vehicles, but selling them with much healthier economics. If second quarter vehicle margin holds near that level, it could become the strongest bullish signal in the entire report. But if margins drop hard, the delivery growth suddenly looks much less powerful. And this is where the leak in the story really is. NIO already warned that rising memory chip costs, battery materials, lithium carbonate, NCM, copper, aluminum, and other input pressures could add more than $2,000 per vehicle starting in second quarter. That is the hidden test. Everyone sees the delivery growth. Fewer people are watching whether those deliveries still made sense financially after cost pressure hit. If NIO protected margins anyway, the stock could finally get a reason to move. If costs ate through the improvement, the market may punish the stock even if revenue looks good. This is exactly why September 1st is not just another earnings date, it is a credibility test. The company has been telling investors that scale, new products, and better mix can push the business toward profitability. Second quarter is where that story has to survive real pressure. The ES9, ES8, Anvo, and Firefly are all helping volume grow. But the market now needs to know whether the three-brand strategy is strengthening the company or just making it bigger and more complicated. That is the part bulls should watch closely. More deliveries are good, but profitable deliveries are what change a stock. If Anvo and Firefly drive volume but dilute margins too much, Wall Street may stay cautious. If the premium NIO brand and high-margin models keep the overall economics strong, while the lower-priced brands add scale, the entire story becomes more interesting. That would mean NIO is not simply chasing units. It is building a wider ecosystem that can actually support better financial results. Then there is the Chery headline. Chery reportedly invested about $10.8 million for a 10% stake in Weiju Technology, a NIO-controlled energy tech business. This is not a massive financial event. It will not transform NIO's balance sheet, but strategically it matters because another automaker is putting money into a NIO-linked energy operation. For years, investors have debated whether NIO's battery and energy infrastructure is a moat or just an expensive burden. Outside capital does not prove the whole thesis. but it does suggest the infrastructure may have value beyond NIO's own vehicles. Still, the cherry deal is not the catalyst that decides the stock. Earnings will. The market wants to see whether NIO's margin improvement survives second quarter. It wants to see if operating expenses stay controlled. It wants to see whether cash burn improved or worsened, and most importantly, it wants management to sound confident about the second half of 2026. If the company gives weak guidance or avoids specifics, traders may treat the report as another disappointment. But if management shows that July and August momentum is strong and that the margin story is intact, the stock could finally start acting differently. The reason this setup is so intense is because expectations are still low. NIO is trading around $4.60, even after stronger deliveries and a major first quarter margin improvement. That tells you the market still doubts the comeback, and that doubt creates both risk and opportunity. If earnings are weak, the stock may stay trapped, but if earnings come in better than feared, the reaction could be much stronger than people expect, because investors are not currently pricing NIO like a company that has already fixed its problems. The bull case is simple. Vehicle margin holds up, gross margin stays healthy, cash burn does not scare investors, operating expenses remain controlled, and management gives a confident second half outlook. If that happens, the slight second quarter delivery miss may fade into the background. Investors may focus on the bigger picture. NIO is growing, margins are no longer collapsing, and the business may finally be moving toward a more sustainable model. The bear case is just as clear. If margins weaken badly, costs rise faster than expected, cash burn gets worse, or management sounds cautious about second half deliveries, the market may decide the turnaround still needs more proof. That would be painful because the stock is already fragile. A company trading under $5 cannot afford to give investors another reason to wait. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. So when you hear NIO earnings leak, do not think about a fake secret document. Think about the clues already sitting in plain sight. Deliveries were strong, but not strong enough to hit guidance. Margins were excellent in first quarter, but second quarter brings real cost pressure. Cherry's investment is small but strategically interesting, and the stock is still priced like Wall Street does not believe the story yet. That is what makes September 1st so important. NIO does not need perfection, it needs proof. If the company shows that second quarter growth came with margin strength, cost control, and real confidence for the second half, this earnings report could become the moment investors start looking at NIO differently. But if the numbers reveal that the improvement was weaker than it looked, the market may decide the comeback story was not ready after all. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.